I want to welcome you to the second in our series of fall webinars here this year. Today's topic is one that's kind of near and dear to our hearts. It's financing a sale to an ESOP, and our speaker is Bob Massengill from SES Advisors. Bob's a well-known, recognized expert in the field of ESOP, so we're pleased to have him here today. If you would like to know more about the basics of an ESOP, we're not going to be covering a lot of the basic parts of an ESOP. We're going to really kind of be focusing on financing a sale, but I'm sure Bob can answer questions as they come along. But we have already done a webinar in the previous series that we have a recording available on our website that kind of gives a basic overview of selling your business to your employees. So after listening to Bob today, you wanted to go back and revisit that webinar, you can get a sense of some of the other issues that might be involved. So I think at this point, I'm just going to go ahead and turn it over to Bob.
Chris, thank you very much. Well, welcome everybody, and I do strongly encourage questions along the way. As I know several of you know, I could talk for a long time about ESOPs, and it's much more interesting if we can get some specific questions, so I'd encourage you certainly to do that. The technical level of this discussion, I would say, is medium. It's not advanced and it's not explicitly basic. But I think the important things to talk about really is lending from or borrowing from the lender's perspective. If you have an idea of what your bankers are thinking about, then you begin to plan a little bit better about how your individual transaction may or may not be structured. I've found in negotiating with banks, you don't want to be negotiating things that they can't change, because you just waste your goodwill capital on trying to negotiate things they can't change. So part of what I want to talk about today is really what are their perspectives and where can they move. So we're going to talk a little bit about loan sizing, collateral. We're going to talk about really the best thing about ESOP debt, and that is some tax incentives. We're going to talk about ratios and considerations. This is really the banker's perspective of a transaction. And we're going to spend a little bit of time as well to talk about the marketplace, because as everybody knows, things have really changed dramatically in the past couple months. And then I'll offer, for whatever it's worth, some tips and tactics. So really, probably the thing that the lenders misunderstand the most, because it really only exists for the ESOP, is the ability to pay the debt back on an entirely pre-tax basis. Now, everybody can pay back interest pre-tax, but the ability to take a tax deduction for the capital value of that loan, i.e. the transaction amount, makes the cost to the company much lower, making the equivalent loan for normal purposes in the ESOPs very different. The ESOP loan will have a much better cash flow and therefore greater debt capacity for a given cash flow. So as a borrower, the company could really interpret that one of two ways. Their given cash flow either capitalizes a larger loan, or the same dollar amount requires less cash from the company. And so I want to illustrate a couple things concurrently. Number one, the primary structure for ESOP loans, and then secondarily, where these goodies actually come into place. So in the normal circumstance, we have our lender, our company, the shareholder named an ESOP, and the selling shareholder named Jim. Now the ESOP, of course, is created by the company with all of the plan design considerations that the OEOC addressed in its other webinar. So important concept number one is that the bank is going to make a credit decision for making a loan to XYZ Corporation, the purpose of which is to fund an ESOP transaction. Recognize how I said that. The bank is going to make a credit decision about the company's ability to pay back the debt. This is a bank loan. It's not different than any other loan from the bank's perspective that it's made before, because that loan will be going to the company. The bank is going to look at the company's cash flow capacity, its debt borrowing, or its collateral capacity, management depth, and a bunch of other things that we'll talk about in a minute. But we'll assume for a moment in this particular instance that XYZ has arranged with its lender to make a $5 million loan because It's going to affect a $5 million transaction with its ESOP. So the bank makes a loan to the company. This is called the outside loan or the bank loan. And this will be on terms that will range between 5 and 7 years, and that will be repaid in the normal course pre-tax interest after tax principal. In the next step of the transaction sequence, the ESOP will make a loan, the company will make a loan to the newly formed ESOP for that same $5 million. This is known as the inside loan or the ESOP loan. And this loan, number 2 here, can be under entirely different terms and conditions than our bank loan or the outside loan. And there are many reasons for this, but primarily it is the company making an independent determination on how quickly the shares that the trust buys are allocated to the employees. And over what period of time does the company want to take its tax deductions, because all of the principal payment tax deductions are generated via the inside loan. We create net a principal deduction by virtue of this contribution that the corporation is making to the trust. And over what period of time that $5 million tax deduction is taken is a function of how quickly the corporation contributes to the trust and how quickly the trust repays the company. Now, it's not unusual for a bank loan to be 5 to 7 years and our ESOP loan to be much longer, with the ability of the trust to repay this debt subject to the company's needs, both from a tax planning perspective and a human resources perspective. The faster the ESOP pays off its loan, remember, the faster the number of shares that the trust bought with that capital are allocated to the participant accounts. And there is a school of thought that says we really don't want to pay off the ESOP debt in so short a period that our new employees 4 or 5 years down the road aren't going to get any allocations because we've already paid them out. So fundamentally, the corporation struggles with its desire to reduce taxable income by making large contributions, with the HR risk, if you will, of creating excessive expectations for participants to be getting very large retirement benefits that will cease earlier than later. And so the reason for structuring these loans over different terms is to give the company flexibility in terms of paying a reasonable retirement benefit, to be able to make this benefit last for employees that are going to join the plan in the future, and also to reduce taxable income. So this loan, the inside loan, is structured between the corporation and the ESOP on entirely separate terms, again, to be determined by the board of directors. And of course, now our ESOP has the cash, so the ESOP turns around and transacts with our owner. In this particular case, Jim, the shareholder, is tendering 50% of their outstanding shares for $5 million. This, of course, implies a 50% transaction. So this really is the share transaction, and the way most bank finance leverage ESOPs are structured. Some transactions use a combination of bank financing and seller financing, and in that particular instance, if Jim were to, see if you can follow the bouncing ball here, if Jim were to finance $2.5 million of this $5 million deal, we would still make an initial loan from the bank or by the bank in the $5 million. If Jim was going to finance 5 of it, then he would take $2.5 million of the 5 he just got for selling his stock. He would make a loan in the amount of $2.5 million to the company, getting a note back from the company, not the ESOP, and then the company would in turn pay back the bank, so that the day after this transaction, the bank funds 5 at closing and gets back $2.5 million, quote unquote, a day later, in which case XYZ has a loan to the bank for $2.5 million and a loan to Jim for $2.5 million. The repayment wouldn't be affected except for the company would be writing two checks to its lenders, the bank and Jim, and how that loan is structured and whatnot is a function of when Jim wants to get paid, when the bank will let Jim get paid, and things of that nature. Are any of the folks that are on with us, do any of you folks have ESOP transactions that are structured both by the seller and the bank, and do you have any questions on that particular aspect? Feel free to jump in and ask a question. Okay, and does everybody understand that distinction between just adding Jim as a note holder by having him return some of that $5 million to the company so that he has part of the note as well? Hopefully that's pretty clear.
I'm curious. This is Mel. I'm curious why you would do a $5 million bank loan and then repay the $2.5 million the next day, rather than doing two separate loans, one for $2.5 and then a self-financed at $2.5.
Well, there's a good reason for that. Where does Jim have the $2.5 million to begin with, right? And secondly, he's got to transact with the ESOP for a total amount of $5 million. And I think at the end of the day, Jim would prefer to have a note from the company rather than the trust. I presume, Mel, you were thinking that perhaps Jim would enter into a note with the trust rather than the company for that $2.5 million?
Well, it actually could be done either way.
Yes, it can. Yes, it can. And that really gets into, other questions. For example, whether or not the transaction is going to be a 1042 deal, and whether it's just going to be a taxable sale. And if it's a taxable sale, you begin to get somewhat indifferent. There may be preferences mildly favoring one way or the other. But for a 1042 deal, this is a more common approach.
Okay.
Good question, though. Okay, so we talked about the thing that the bankers love best about ESOP financing, and that is the cash flow savings. We alluded to that in one of our first slides that discussed the ability on similar loans to capitalize a larger loan or to use less cash flow on a given loan. And here we're illustrating the value of that principal tax deduction, having made certain assumptions about it, that ultimately generates a company savings on a $5 million transaction of nearly $1.9 million. Now that comes in the form, at a minimum, of the value of the principal deductions as the ESOP repays its debt, not as the company repays the bank, but as the ESOP repays its debt, or maybe to say it more precisely, as the corporation contributes more to the trust. And secondly, if we presume because of each of those payments, our cash flow in a given year is a little better, and the corporation opts to pay down the debt somewhat faster because it's got a little better cash flow, that the value or the cost of the interest expense is declined because the principal isn't outstanding as rapidly. And I've made an assumption based on some calculations that we save about $60,000 of interest expense. And when we total it up, also netting out for the tax deductibility of the interest, almost $1.9 million for that same loan. And that really is the essence of why it is that the ESOP is, on a current basis, much less expensive than bank debt. Now recognize that the obligation of the corporation is to make a market for employee stock down the road, and so it's not that this is necessarily it is a permanent savings, but we also recognize that there are costs down the road that are going to have to be borne by the corporation, and this is really one of the ways the government is helping corporations to make these benefits happen. And of course, depending on how the stock is redeemed, it could also still be done on a pre-tax basis if it was either if departing participants either sold their stock directly to the trust, which could only have gotten the capital by contributions on a pre-tax basis by the company, or the corporation bought the stock back, which is the legal obligation, and then the corporation turned around and contributed that treasury stock into the trust, therefore creating a tax deduction in that manner. So this really is probably the most valuable in terms of dollar amounts of the tax benefits available. You all are, I'm sure, familiar with 1042. 1042 is a seller benefit, and that the federal long-term capital gains rate of 15%, that's about 30% or so, maybe even 40%, or excuse me, about 20% or 25% less valuable than this corporate tax deduction. So this is really one of the important aspects, one of the important leverage modules of the ESOP transaction. And this is quite important for the bankers to understand because this is what they struggle with. They're not accustomed to seeing a debt being paid back on a pre-tax basis. And when you tell the banker that the loan is being paid back pre-tax, I assure you they're going to scratch their head a little bit. And it's the reason that we present our financial models to lenders in a slightly modified GAAP basis to really drive that home. And I illustrate this here in a moment or two. So that really is some basic leveraged ESOP transaction structure along with the illustration of the tax savings. Let's now talk about how it is banks size up the loans, which is to say, how do they determine how much a company can borrow and also how much a company should borrow. And they're really three, clearly two, but implied in the two are some other objectives or whatnot or constraints. And we really are going to look at both a combination of cash flow borrowing capacity and balance sheet debt capacity. And of course, the cash flow debt capacity is a way of saying, can the company afford to pay the bill? And the balance sheet debt capacity is a question that says, in parentheses, if the cash flow dries up, how do I collect my money? And that's really the two standards that any senior lender is going to be focusing on. Recognize that the banks are lending their depositors money, and they want to make sure they get it back. And so they need both cash flow and collateral to make these loans. So I'll walk you through really their standard analysis, and every bank does this a little bit differently, but they all end up at the same point. Their analysis and their standards and their criteria change on market conditions, but the analysis is really quite the same. So what they generally start with is a historical viewpoint of the company's operating history. And what we're talking about here is we're driving at the cash flow capacity. And what they will do initially is they'll look at the historical earnings, this historical cash flow, and they will also begin to evaluate the absolute numbers, but they'll also begin to look at the volatility of those numbers. And you can see here in the example of a client of ours here, the cash flow or the EBITDA number does vary. And obviously the last couple of years in this analysis have been better than the prior two. And the owner might be making an argument that really the cash flows for 06 and 07 are most representative of the company's future, but the banker is not going to ignore 05 and 03. You know, you can see a pretty reasonable jump in revenues over that time period, and so the lender is really going to want to know why those revenues have increased and are they sustainable. And they'll make a judgment about that, and then they'll also look at the company's projections that will be provided, and they will begin to compare the projections relative to the history of the company. And they will begin to see a picture of whether or not it's a hockey stick projection, which is to say there's been a very stable sales and profit growth of the business, and now all of a sudden there's an extraordinary growth rate in sales and profitability. They will look at any volatility of both the historical and the projections to begin to try and figure out what the company can, in bad times, reasonably expect to pay. And really the cash flow number, or EBITDA, which is earnings before interest, taxes, depreciation, and amortization, it's an acronym, is able to pay. So we go into the next slide, having looked at our historicals and our projections, and we begin to arrive at a number. In this particular case, we've deemed the average EBITDA of the company to be about $2.2 million. We could have a whole discussion about whether average EBITDA is right, weighted average, if we ignore some years, but the bank comes up with this determination, and they divide it. I see here I say multiply it by it. We divide it by the cash flow coverage ratio, which is nothing short of the amount of money given their average EBITDA expectations for the future that they will allow a company to use. So if they believe over the next several years the company is going to generate $2.2 million of EBITDA or cash flow available for debt service, the bank is going to cap at $1.5 million how much it will allow the corporation to commit to this loan amount. And if we capitalize this $1.49 million for 5 years and at a 6% borrowing rate, we come up with a loan value of about $6.2 million, and I'll show you our balance sheet in a second. We have some existing term debt of $700, so our cash flow borrowing capacity is the difference between those numbers. It would suggest that at a $2.2 million average cash flow that the company could borrow an additional $5.5 million. Okay, that's step one. Do you have the cash flow to make this happen? The next equation is going to be, do you have the balance sheet to back it up? If we have to sell everything you own, honor all of your obligations, what's left over to pay off this debt? And there's a standard matrix, and this gets much more involved and interpretive than I'm showing here on this very simple slide, but this is a starting point where we look at the corporation's assets, which are booked at cost. We adjust those values to reflect fair market value in a manner that would be determined after evaluating each of those asset classes, determine a fair market value of those assets, and then begin to determine how much the bank would credit that asset for if it had to sell it. Some assets are more valuable from a liquidation perspective and more certain than others, and so the bank gives a better advance rate on receivables, on inventory, depending on what it is, plant, property, equipment, and other things. You'll notice they don't advance anything on cash, even though this company has three. They would tell the lender, look, just use your cash, borrow less. Well, when we complete this analysis and we add this column, we see that a $4.2 million balance sheet capacity is what's available. So we see that the corporation has an ability to borrow from and repay on a cash flow basis $5.5 million, and we see that its balance sheet has a capacity to support 4.2, and the question is, what do we do with the rest? And what we do with the rest is we fill it up with either a limited personal guarantee where the owner says, I will back up that difference. It may be that the seller will go ahead and take up that difference themselves. Perhaps that's where our seller note comes into play. Instead of borrowing $5 million from the bank, the company borrows $4 million, and Jim, our seller, provides financing for $1 million. And there's also a third category, which is cash flow financing or mezzanine capital, which is essentially cheap equity. The providers of this cash flow financing don't require collateral, but they require, because they're taking additional risk, a lot higher return. And if right now the bank markets are 6.5% to 7% for senior debt, you can easily double that for this other financing. And it usually comes in the form of a current interest payment with a makeup payment at the end of the loan term to get them their return as much as 10-11%. There are some transactions that use this one. This is generally reserved for larger transactions rather than smaller ones, but this is the third way of making up that difference between the senior debt borrowing capacity, which we talked about, and the transaction amount that the owner wants to do. So what are the normal loan terms that we'd expect in the market? Well, we're going to use the revolver on certain occasions, plus term loans to finance this transaction. I will tell you that if you have volatile earnings and you rely on your line of credit for operations, you should not tap your line of credit for a transaction. If, on the other hand, you've got an unused line that you only need for year-end planning purposes, then you might consider putting some of your loan against your line of credit and terming out the balance. That has the benefit of not requiring amortization on a part of the loan. And in the case of this particular case we're looking at, that might be a way to do it. We'd have to look more carefully. There are going to be covenants, which essentially are warning signals to the lender based on liquidity, leverage, and coverage, so that the bank gets an alert if any of these covenants are tripped. I've omitted to adjust this particular senior debt capacity. This senior debt capacity is 2.5 times, not 4 times now. I know I got it in another slide. The loan terms will be up to 7 years. Sometimes, in fact, we have an ad agency up in Lake Placid, New York that's getting a 10-year amortization and a 5-year term. So they get the benefit of a longer amortization period, but at the end of the 5 years, the bank gets to revisit this whole transaction structure to decide if they want to stay in. Pricing is anywhere from 1.5 to 4 points over the pricing indexes, which will either be the London Interbank Offered Rate, LIBOR, or the prime rate. Right now, 1.5% is very low. 2, 2.5, 2 3/4 seems to be about closer to market. There, generally speaking, are nominal fees on the bank side for these loans, and they can typically get waived. I talk about 3% here because if you're going to get into the cash flow financing world, that's definitely a kind of fee you'd expect to pay, and the due diligence costs are also there. That's at a minimum the bank's lawyers. There's a question: do the nominal fees get charged typically on smaller loans? I will tell you that for senior bank financing, when a bank asks for a fee on the loan, it's probably the easiest thing to get rid of, especially if you're not looking to borrow your last dollar. If you're really stretching the borrowing capacity of the company, they're not going to be as inclined to waive that. If it's a very modest loan amount, you can expect that you will. We'll talk about some of the important ratios and considerations. The two that you'll focus mostly on is called a fixed charge coverage ratio, and this is nothing more than looking at the cash flow available for debt service divided by what you're scheduled to pay. And that number has to be typically 125 or better. And the debt-to-equity ratio is really a somewhat archaic metric that bankers still use. But because of the way ESOPs are accounted for, we've got to ignore one of the components of our equity section. I'll chat about that in a second. The other considerations that you've really got to think carefully about is what are your future borrowing needs? If you're going to borrow $4 million from your bank today and you know you have a capital project requiring $3 million in the next couple of years, then we'll want to make sure that we're reserving capacity for that important transaction and not using every lick of capacity that you have just for this transaction. Or to say it differently, hopefully by the time that capital project requires funding, you will have paid down enough of that debt to create that capacity. And there are special considerations in leveraged ESOPs if you're in the contracting business and they're doing a lot of public work with respect to bonding and your sureties companies. And if you're in any kind of franchise business, there are various approvals that'll be needed. I quickly want to show a couple of the ways that we show the income statement and the balance sheets. Earlier I said that we show our bankers a slightly modified GAAP statement, and what we do, because the ESOP expense on an income statement is a non-cash charge, we do not include it in SG&A, which is the way it would be presented for GAAP purposes. We separate it so that they can focus on what is the operating income of the ESOP pre-ESOP. We take out our non-cash ESOP expense, and then we're left over with what is the true operating income. And then we take out our interest expense and derive our numbers that way. So if you were looking at a GAAP statement, you would not see the ESOP expense broken out here. It would be part of SG&A, and our second operating income pre-ESOP line would actually be our operating income line. But what I'm highlighting here is to get the lender to focus on the fact that our real cash flow is the operating income pre-ESOP, not after ESOP. The other thing that really gets bankers in a twist is the accounting for ESOPs, and what I've done here is I've shown on the top two lines how we book the outside debt, or the bank loan, and we are going to credit short-term portion of long-term debt, current portion, and long-term debt on the right side of the balance sheet. And even though the corporation, and that is the accounting for the loan between the bank and the company, and then as soon as the company makes a loan to the trust, even though that sounds like an asset to the corporation is making a loan to the ESOP, that sounds like an asset. The accountants require that we booked it as something called a contra equity account. And that contra equity account is nothing more than a treasury stock looking account here on my third yellow line called unearned ESOP shares. So you can see that our book value dropped by $5 million, and this is where, when we're using a debt-to-equity ratio, they get apoplectic. And so, again, oftentimes we will break out that unearned ESOP shares to show the owner's equity before that contra account and afterwards so they get it. Now, the good news with the way the accounting for ESOP works, unlike treasury stock, is that in the second year, as the ESOP pays off its debt, you can begin to see that this unearned ESOP shares numbers goes down. Unlike treasury that stays the same until these shares are either retired or reissued, the ESOP loan will be retired as, or this contra equity account will be retired as the trust repays its debt. So that's something to talk about. So in our remaining 7 or 8 minutes, I want to talk about the banking environment. Well, actually, before I go on to that, are there any questions? A couple came up in the chat, but is there any questions about this accounting or any of these other issues as it relates to loan sizing, important considerations? Please don't hesitate to ask.
I have a quick question, Bob. This is Chris.
Yes, please.
Do you sometimes have to educate accounting people who aren't familiar with these types of deals about?
Absolutely. In fact, I will tell you, it is not at all infrequent that we see the accounting for ESOPs entirely wrong on statements. I'm not saying it's common, but it is by far not unusual.
Okay.
For the accountants out there, ESOP 93.6 is what really lays out the guidelines for accounting for ESOPs. And that's this compensation expense and the contra equity account unearned ESOP shares that gets the most attention.
Okay, great. Thank you.
Anyone else? The banking environment today. Is anybody out there in the market for a loan today that's willing to admit it? It's a tough market. It's a tough market for a few reasons that we'll talk about and I'll show you. First of all, there are really 3, call it 4, quick measures for figuring out where the banking market is. Credit standards, loan spreads, loan demand, and senior debt funding limits. That fourth one is actually a little trickier to tell than the other 3. The other 3 are published, and you can read about them every 3 months. The senior debt funding limits change in the marketplace, and you've got to be out there borrowing money to know where banks are. But as it relates to credit standards, it's how banks assess their credit risk. Do they believe the projections? Are they willing to be more or less accommodating on the collateral capacity? Are they willing to advance more than 1.5 times on a fixed cash flow coverage ratio? These are the credit standards, a different means that they have to constrain the borrowers of credit. The loan spread, and the loan spread is nothing more than the bank's borrowing rate over the lender's cost of money. This is their markup. Banks are in business to mark up their money. They lend out their capital at more than they pay for it, and they get a spread on it. And so these spreads change in different times. They're very much a function of competition and the general economic climate. And in competitive times, which we are in for a good solid couple of years, they will lower their spreads so that they can compete and offer less expensive capital in order to earn the corporation's business. And lenders have any other numbers of sources than just their loan product to make money. They make money on their treasury management, if there are lines of credit, if there are overseas accounts. They have other LCs that they can offer, and so there are lots of different ways to make money for the bank other than their loan spreads. But loan spreads are one indication of where the markets are. And then, of course, loan demand is nothing more than a reaction to the changes in credit standards and loan spreads. And not surprisingly, these rates and demand fluctuates with not only the banking environment but the owner's outlook of the business. So what I've done here is to offer our group a perspective on the variability of interest rates. This data is published by the Federal Reserve Bank. There's a study known as the Federal Senior Loan Officer Survey that we draw a lot of our data from about loan spreads and about credit capacity and these things. And you can see that the prime rate varies quite a bit. And in the more recent period, we can see that since 1980, the average prime rate has been 8.8%, and today it's 4%. So it is relatively low. Now, let's go to credit standards. The credit standards, and this is Fed speak, they talk about the net percentage of respondents tightening standards, and that's just no more than X% are tightening and X% are loosening, and what is the net difference? And you can see that from the period of 2007, there were an equal number of banks tightening and loosening credits. Basically, it was static. You know, they either weren't changing or they were changing in equal balance. And since that time, you can see, and I've highlighted a more recent picture here of how these credit standards have tightened since the middle of 2007. It's not a surprise to anybody. What is surprising is that nearly 80% of all the banks out there are still tightening standards. And this is not an unusual cycle that you can see. And if we go back here, you can see that there's a peak. I don't know if you can follow my pointer. There's a trough, there's a peak, there's a trough, there's a peak. This is very standard. Now the other thing is the spreads. Remember, we talked about the loan spreads. And you can see here the same cycle. Peak spreads, trough spreads. Peak spreads, trough spreads. And if you look at, and this is even more telling, the most recent data suggests that from the beginning of 2007, when the credit standards were tightening, so were the loan spreads. But in the last October survey, 100% of the lenders in the marketplace were tightening standards. 100%, up from 80% in July. If we go back, and I didn't go back far enough in history, but I've never seen a peak. You know, at the peak of the last credit constraint, which was 2001 or so, which was a very difficult period, it peaked at around 60%. We are at 100% of the lenders. And this is a fairly current survey. I'm not going to suggest for a moment that it's every lender. And the good news is bankers are lending. On the other hand, they're being very scrupulous and very cautious about the capital they are putting out in the market. Well, you've got tightening standards. You've got increasing spreads. What do you figure happens to demand? Well, inverse curves to the credit standards. When credit standards are loose and spreads are low, we have a very high demand. And guess what happens when the credit standards start tightening and the loan spreads start going up? It's not surprising that our loan demand drops. And so this is the story we're seeing in the marketplace today. And we'll continue to see probably for the next few months. Now that the TARP program that the Fed and the Treasury and the government's put in place looks to be handling this pretty well. We are in the market right now with probably 6 or 7 leveraged ESOP transactions. We've closed 6 in the last 2 months. Those 2 months being these difficult periods of time with tightening standards and increasing spreads, and they're still getting done. So the good news for ESOP companies is that they tend to be very good companies. They tend to be under-leveraged, and with the right collateral packages, these deals are still going to get done. My prognosis for 2009 is we're going to see more ESOP transactions occurring in the 30 to 40% range, which has been the historical milieu or environment for these transactions because of, 1, the credit capacity, but 2, because owners are probably going to intuitively feel like their stock price isn't exactly where it ought to be today. And so sell a smaller block today, satisfy some of the liquidity needs they have, and wait down the road for a better day to continue to transact. Those are my prepared comments. I'm more than happy to take some questions. I want to finish on time, and I'll open the mic for any questions. There's lots of material there to talk about. You may have some questions. Fire away.
Bob, this is Lou. Got a question for you?
Sure.
We are a 30% ESOP. We set it up back in 2000 and made the first transfer. It was a leveraged ESOP. Took 5 years to pay down. So we're at that point where we're looking at the next stage, and I am the seller, by the way. So do you find that most companies go from 30 right to 100, or are you seeing more of a middle road going from 30 to 50, 30 to 60 or 70? What's most typical?
Well, you know, Lou, that tends to be an individual. That tends to be driven as much by the owner's goals as the company's capacity.
Yeah.
Certainly, in the last several years, there has been a dramatic and absolutely a tectonic shift between the number of 100% ESOPs. To give you some perspective, in 1998, when the tax law first allowed ESOPs to be shareholders of an S corporation, there were only 5% of the ESOPs in the country that owned 100% of their businesses. Today, that number is closer to 36 to 40%. So clearly, a lot of people have taken that route. And I would just suggest, Lou, that if that was the route you would want to go, you're going to evaluate a couple things. But seller financing is, if you're going to go 100%, is definitely going to be part of the equation. And it may be, depending on what your liquidity needs are and the like, that even financing the whole thing yourself may be a reasonable approach. A lot of owners right now are saying, golly, if I could get 7 or 8% return on my note, that's better than if I borrowed it from the bank and put it in the market.
Right.
So maybe holding a note until the credit markets settle down a little bit may not be a bad deal. That'll reduce your transaction costs. I'm certain that in a 70% deal, you'd be able to draw some capital out that would make other strategies available to you. But to answer your question, it's not at all unusual for companies to go 100%, especially if that's your desire for the ownership of the business.
Right.
That was a long answer, I know. I'm sorry.
It's great. Thank you.
Yeah.
Bob, I have another quick question.
Sure.
This is Chris again. I guess it's kind of similar to the question I asked previously. When you're if I'm a business owner, would I be better off finding a lender who is more familiar with these types of transactions than not? And like in the overall strategy of advisors that you would pick, because the issue a lot of business owners have is when they see all these things, they look at it as just additional costs to hire a different CPA firm or an additional CPA firm other than the one they've always used, another lawyer, another expense there, and so on and so forth down the line. Are those issues that you see?
No, not really, Chris. I think your question was, do you want lenders familiar with the ESOPs to save transaction costs? And I don't think those are directly linked. We've worked with enough lenders in every market in the country to know that if you're banking with brand X that has done an ESOP, whether or not they're in your marketplace, and we can help direct that banker for brand X in your market to the banker of brand X in some other market that just did a deal with us and help them understand. And, of course, we've spent some time coaching, too. The presumption that you made about additional advisors, CPA firms, I don't see at all. It's very infrequent that advisors are changed because of the ESOP. I think what we're seeing now is a little bit more pressure from the lenders for companies that are borrowing a lot of money to get audited statements, but that's still very much a choice rather than a requirement. Our law firm, Staker, Fisher, Edwards, and Greenapple, when it works on a transaction, works only for the transaction and goes away. So the idea there is that they're specialists in these transactions, and so rather than having your corporate counsel, who may or may not be familiar with this, spend extra time making this deal happen, you get in some experts that know this like falling off a log and get it done quickly and then leave. There are a couple of lenders in the marketplace that are familiar with ESOPs, but we don't have any trouble educating all the likely suspects.
Okay, makes sense. Great, thank you. Do we have any other questions?
Well, thank you very much. Just one unabashed plug for SES Advisors. We are among the largest ESOP advisory firms in the country, and we work with owners in structuring transactions, whether they're initial or secondary. We're based primarily in the East Coast, but have recently expanded out west to California. And we do, once transactions are completed, we also do ongoing record-keeping services and run about 300 plans across the country. And as I alluded to earlier, our sister company, Staker, Fisher, Edwards, and Greenapple, is a law firm that does all of the legal work, or most of the legal work for our transactions as well. So I want to thank Chris and the OEOC for having us. Hopefully this has been a helpful session. And if anybody has any questions of me in particular, don't hesitate to call or email. We'd be happy to chat and talk further about your specific questions offline.
Great. Thank you.